My name is Garth and I'm a technical analyst and an ETF strategist with traderscorner.co.za. I'm giving you my weekly update on the S&P 500 as usual. And I'm going to start with a long-term look at some weekly charts going back over the really long term, over the last 10 years of bull market, and then narrow it into the daily chart and then to the hourly chart and show the more relevant levels as we see them at the moment. So let's start with a long-term look at the weekly chart. And what's evident here is that the market broke down below this long-term rising trend that we had seen since 2009. That trend line was broken in March when the market crashed down through that long-term trend line. It traded all the way down nearly to 2200, but for the purposes of this chart, this is a line chart on the weekly basis. We look at the 2400 area as being quite solid lateral support, and you can see that for the most part, that solid lateral support level did hold, and the market has subsequently staged a pretty impressive bounce off of that lateral support zone. What is now happening is the market seems to be pushing up and giving a throwback to the underside of the previous rising trend, and also giving a throwback into the underside of the 50-week moving average, which is also interesting. So we're approaching a pretty critical area of resistance for the S&P 500 now, and we really need to see what happens here in the next few weeks. If we move on to the next chart, this is also a weekly chart of the S&P 500. It's just slightly more zoomed in. It really shows you the last 2 years of trading history here. And you can see the big move to the downside in March, and we've seen an impressive rally off the lows. It's looking very much like a V-shaped bounce in the market. And obviously there's much discussion and confusion out there, I guess, as to whether the economy is going to reflect this V-shaped recovery in the stock market or not. And that remains to be seen. But from a technical perspective, you can see the market is now pushing up into the underside of that 50-week moving average. And I always like to view that as an indication of bull market or bear market. If you're below the 50-week moving average, that is typically a bit of a bearish environment, and above the 50-week moving average is a bullish environment. So as we sit now, we're right up against that 50-week moving average. The exact level comes in at around about 3,000 on the S&P 500. So we're going to watch that very carefully in the week ahead. Also notice the relative strength index in the top of the graph here, and that is showing that the RSI is now testing 50. And again, rough rule of thumb here is that in a rising trend, your RSI stays above 50. In a declining trend, your RSI stays below 50. So with it now testing that 50 level, it's quite a critical junction at this point in time. The next chart takes a look at the daily trading activity on the S&P 500, and this looks back over the last 5 months. And what's evident here is that the market for the last 3 weeks really has been range bound between 2,800 up to about 2,940. Notice the 61.8% retracement of this entire sell-off is coming in at around about 2,935. The market's been bumping up against that 61.8% retracement quite a bit over the last 3 weeks. Yesterday's session, being Monday, was a big session to the upside, and we saw a huge gap to the upside there. It does look as if this market might want to have a look at 3,000, and then we'll have to see. That, interestingly, is where the underside of the 200-day moving average comes in there in red. And also notice to the left of the chart in March, there was a gap up at 3,020. So maybe we see the market pushing up to that 200-day moving average, perhaps having a go into that gap, and then we see what happens from there, whether it is able to be sustained or not. The final chart that I've got for you here today zooms right in on the hourly chart of the S&P 500. And on this chart, you can see quite clearly the range-bound activity over the last 3 weeks between 2,800 and about 2,940. Interestingly, there was a false break to the downside last week below 2,800, and that didn't follow through. So, technically, a false break in one direction out of a range often results in a violent break to the opposite end. And that seems to be what we're getting here now. So the market has broken up through the top of that range above 2,940. So I suspect we could be looking at a test of 3,000 here in the near term on the S&P 500. And then we'll need to see from there whether the market stalls and takes a bit of a breather from that level. That's all I've got for this week. I'll be back again next week with another look at the S&P 500 and perhaps some ETFs to trade.